Hi, everybody. Today is CPI Day, July 15th. So, we're going to break down the CPI inflation report day. Scott Riley, the market update desk, NMLS 157524. There was a lot of concern with the CPI report today, specifically because the replacement value, what we were dropping off of the 12-month aggregate from last year, was a 0% reading, a flat number. So pretty much anything we got today was going to show an increase in year over year inflation. So we did alert customers to what was coming, and luckily many of them locked in and saved some money. Let's break down what the report showed us. So the overall headline CPI came in at up 0.3%. Now, that was spot on with the market forecast expectations of 0.3. It did raise the year over year headline CPI from from 2.9%. From 2.7% to 2.9%. So there was an uptick there. Energy led the way with a 0.9 increase, and we also saw food increase by 0.3. Now, the core, which strips out the volatile food and energy, saw an increase of 0.2, but that was better than the market expected of plus 0.3. So we got a little benefit there. Now, year over year rose from 2.8 to 2.9%. Within this category, we saw used car prices down 0.7%, and new cars also were down minus 0.3%. Shelter came in at a friendly 0.2% up. That brings the year over year shelter downward. First time we said that in a while. That came down from 3.9 to 3.8%. Where's all this showing? This was supposed to be the report that was going to be integral in showing tariff impact on inflation. Yet we're not seeing that within the data. The tariffs really are showing to be a one-off and not persistent increase, revolving inflation. So yet another report that did not show what the media and many analysts were thinking would be there. When we look at a shorter term run rate of what the Fed looks at the 3-month and 6-month run rate for inflation. Here's how that breaks down. So on the headline 3-month, it did tick upwards, and that went to 2.4%. The 6-month actually stayed steady at went down slightly to 2.4%. Now the core 3-month run rate was at 2.4%, and the 6-month came in at 2.6%. So we're still seeing some sticky inflation. It's not moving as quickly as what the Fed wants, but we've already moved down large amounts, and this last piece of the puzzle was always going to be very tough sledding, especially when we're in the environment of volatile energy and also, food prices too. So all these things are playing parts in this of why it's taking a while to get down. Also, insurance factors play into overall inflation because car insurance plays a numerical value in that. So that's where the numbers break down today. We're seeing the 10-year bond today tick up 5 basis points to 4.479. Mortgage-backed securities are down 11. So we are kind of at a very important threshold or resistance on a 50-day moving average for the treasury. The next stop is if we break above it, somewhere in the 4.5s, I think 4.52 or 4.53. Now we get the wholesale inflation tomorrow. That doesn't impact the market as much as the CPI or retail inflation does, consumer. Next week, we get the personal consumption expenditure. That's the Fed's favorite measure of inflation. So it's going to be interesting to see how these numbers extrapolate. And I'm double checking to see what the replacement number on that is so that we can be fully prepared. And we're talking with our clients. We got 2 out of 2 offers accepted over the weekend for our buyers. The second one was we were integral in helping them get their offer accepted. It was less than substantially by the highest offer that was on the table. But none of the other loan officers picked up the phone and called the listing agent to explain the buyer's approval and go through the process. So it makes significant difference on who your lender is. Rates aren't as important as who your lender is and the communication. Give us a call. We'll show you the difference. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan, 616 293 2189.